FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. Today is April 4th, 2017. So we have a new sponsor. I'm sure you've heard of them. They are amazing. Casper is a sleep brand. They've created a perfect mattress. They sell directly to you, the consumer, eliminating commission-driven inflated prices. Its award-winning sleep surface was developed in-house as a sleek design and is delivered in a small, how did they do that sized box? In addition to the mattress, Casper also offers an adaptive pillow and soft, breathable sheets. I mean, the quality is just unparalleled. They are incredible. So their obsessively engineered mattress, it's at a shockingly fair price. It combines supportive memory foams to create an award-winning sleep surface with just the right sink, just the right bounce. With over 20,000 reviews and an average of 4.8 stars, it's quickly becoming the internet's favorite mattress. Free shipping and returns to the US and Canada. Look, you can try them for 100 nights risk-free in your own home. If you don't love it, they'll pick it up and refund you everything. Designed, developed, assembled in the good old US of A. You just go over to www.casper.com/FSN and then use this promo code FSN. That's all you have to do. And you'll save $50, which is quite a good deal. It's that simple. Go to www.casper.com/FSN. It's really great, so comfortable. You're going to sleep like you've never slept before. You're going to love it. Promise you that. So check it out now. All right. So we're always looking for new guests, trying to get a handle on what's really going on in the world, especially in the resource sector. There's so much myth. There's so much propaganda. Oftentimes you don't know what to believe, and that goes for myself as well. One of the things, energy prices. So we're at $140 a barrel. When I start the show, we're at $50 a barrel, give or take right now. How do we get there? How do the oil companies adjust? How do they make money at $50 a barrel? It's a really interesting conundrum. So I've got a person we found by the name of Art Berman. Art, you have been in the oil industry now for decades. I don't want to date you, so we'll just say for decades. You worked for Amoco, which is now part of BP. You consult to oil companies, a prolific writer. And the way I came across you, I found an article that you had recently written refuting an article in Zero Hedge. Zero Hedge, I've come across many articles in Zero Hedge that to me just aren't true. I won't call them fake news, but they rest on misplaced assumptions. And this article you wrote a few weeks ago in March 22nd, Shale cost reductions are 10% technology, 90% industry bust. So first, welcome to the show, Art. We're really thrilled to have you on here, and thanks for coming on.
Well, thanks for having me, Kerry. It's a pleasure to talk to you.
So this article, and before that, you'd written another article that I had read. It was the first of yours that I had actually read about basically the downward spiral of the Bakken play, which, if you're not aware of, is the big shale oil play in North Dakota and I guess part of Montana and Saskatchewan. So I read that article with real interest. So anyway, this article that you wrote here, I guess it kind of summed up oil services industry in a depression, right?
Well, that's right, Kerry. So what we've seen is an awful lot of propaganda, a lot of discussion about how the oil companies are just driving costs way, way down because of technology and efficiency. And I don't, for a moment want to dispute that there's a lot of, I work in an industry, and so your guests know I'm not an analyst. I'm not a journalist. I'm a working petroleum geologist. I work every day in the oil and gas business, making maps, interpreting subsurface data, drilling wells. So I'm proud of the business I'm in, and if people think that we're smart, I'm sure not going to try to talk them out of that. But there are limits to what technology, particularly in an old extractive industry like oil and gas. I mean, we've been producing oil and gas in the United States for 150 years. The probability of being able to drive 30 or 40% of the cost out of your product just by technology and efficiency is, frankly, it's unbelievable. When was the last time that you were able to buy an automobile for 40% less than the model you just traded in? It's another old industry, and there are always technological advances that are going on. Before we went on the air, you and I were talking about self-driving cars. I mean, there's no end to technological advances, but it seems like every time I go out and buy a car, if it's the same model, it costs me more. So,
yeah.
Is it just that the automobile industry is dumb and the oil industry is smart? No, it's that there's something more going on. And what's going on is that, as you mentioned in the beginning, the price of oil is roughly half of what it was 2 years ago. And the people that provide the services, the drilling rigs, the logging, all of everything that supports that, they're having desperate times that they're desperate for work, and they've had to slash the prices that they charge. And so the huge proportion of the savings in the oil and gas business are because we're getting our basic services at a fraction of the cost that we were 2 years ago. And if that's positive, well, okay, so be it. But positive for somebody, not so good if you're selling oil field services. So the article that you mentioned is, and I don't know if 90% industry bust, 10% technology is exactly right. It's a headline. Maybe it's 15 and 85. I don't know exactly what it is. But the bottom line is that most of the advantage is just because everything's cheap for a while. That's what happens in a depression, and we're in a depression in the oil business.
Right. So, hey, and the reason it's cheap, the guys who are working are getting paid a heck of a lot less than they were getting paid 5 years ago, right?
Well, right. So companies, if you're an oil field service company, you're losing money. You're bidding a job competitively, and you need the work, because if you don't get the work, then you're out of business. And so what happens in a down cycle in any business is you'd rather lose a little bit of money than lose a lot of money. And so you lose less if you get the work than you do if you don't get the work. So you bid it at a loss, and hopefully it's not so much of a loss that that it helps you to survive a little bit longer. But it's unsustainable. I mean, don't get me wrong. I mean, these companies that are providing these services to us in the oil business, they cannot survive losing money at the rate that they are. So things have to turn around. And when they do, if they do, then the prices are going to go back up again. And you're going to see an awful lot of this miraculous cost savings that's supposedly due to technology and efficiency. It's going to disappear.
Right. Yeah. So, and we've seen this happen many, many times in the oil patch with these service companies. You have really great times. Their prices, rig prices go way up. All the other ancillary services prices go way up. Then there's a bust, and then the prices come down. They consolidate. Other companies go out of business. And the ones that manage to hold on, they hold on for good times, and then the cycle repeats itself, right? I mean, this isn't new.
This is nothing new, and basically what happens, oil is a commodity, and you see this in I think all commodity markets, and that is that when there's a shortage for some reason, the money pours in. The investment money pours in because everybody wants to buy low and sell high. And the result is that with all this money, whether it's oil, whether it's gold, whatever it's soybeans, you get a bunch of money, you gear up, you ramp up production, and eventually you oversupply the market and the price collapses. And then you're in a depression, and eventually you work through the oversupply that was created from the surplus of investment, and then it starts again. So in the oil business, at least, it seems like we're always undershooting or overshooting. And we overshot big time between really the beginning of the 2000s, but certainly after the financial collapse, 2009, 10, 11, 12, we overshot big time, and we created a worldwide surplus of oil, and prices collapsed in 2014, and we're still working through that oversupply. And my guess is it's going to take another couple of years before we're totally out of it, but we seem to have turned a corner, and the prices have come up from a bottom of below $30 a barrel, and I don't expect them to go back there unless the whole economy collapses, and we can have another discussion about that. But barring that, we're back to $50, and that's a whole lot better than 30. So, but that's what happens in the oil business. I think it's typical of many businesses.
Yeah, we see it over and over and over again. I mean, there's been so many booms and busts. Just in my lifetime, my short lifetime, I remember both Arab oil embargoes. Prior to that, I think oil was going for $3.50 a barrel prior to the first Arab oil embargo, and then it was at $10 or $12 a barrel, and then it went up to $30-something dollars or $40 a barrel, and then Reagan decontrolled the price of oil in the U.S., and then it came back down. So,
well, yeah. If you look at if you normalize all that, and take into account inflation and put all that into 2017 dollars, the price of oil before 1973, which was the so-called Arab oil embargo, it averaged about $23 a barrel in today's money. It may well have been $3.20 in the money of the time, but
right.
In today's dollars, it was about $23, $24, $25 a barrel, and that situation pretty much persisted for a long time, and then in the beginning with that event in 1973-74, the price of oil went from $25 to $50 almost overnight. And people like to think about it as an embargo, and that's how it started. But the price never went back down when the war between Israel and its neighbors ended and the embargo ended. So that's another interesting subject. And then following that, in the late 70s, early part of the 1980s, Iran and Iraq went to war with each other, and they're both huge oil-producing countries. So there was a tremendous amount of oil that was taken off the market, and oil prices went up to like $120 a barrel in today's money. And it was those two events that sparked the first really big bubble, all this investment that went into oil and gas production, and they overproduced so much that we went into a depression, and oil prices were back down around $35 a barrel from basically 1982 or 3 until about 2003, and then they started rising again. So that's a little bit of the history.
Yeah. So, and what interesting about this boom in the oil patch part is that it went on for such a long time, much longer than the others in the past. The booms just did not carry on this long in the past, and I think that's why the bust is so pronounced this time.
No, you're absolutely right, and there are reasons for that too, Kerry, and that is that that following the economic collapse in 2007, 2008, as I'm sure most, if not all of your listeners are aware of, monetary policy became a big driver, and at least the interbank interest rates went effectively to zero.
Yeah.
And anyone who used to have investments in things like money market accounts or CDs or treasury bonds or, heaven help you if you just had your money in a savings account, all those people unfortunately know that, the interest rates that you get paid on those kind of accounts these days are just not even worth having. So what happened is that investors, people with money, started desperately searching for yield. Where can we do better than, 2%, or for a while it was even less than 2% on treasury bonds. Certainly we can do better than a couple of tenths of percent on a savings account. And one of the places that really became attractive was the oil and gas business. And so investors could put money, and they could loan money to oil and gas companies, and after a while that converted into, they could buy junk bonds, high-risk corporate bonds from oil and gas companies, and the kind of the flavor du jour for the last couple of years has been secondary share offerings, often in preferred stock, and all of these kind of things. They pay a dividend, they pay a coupon basically, and you can make 6, 7, 8, 9, 10% on these investments, which in a world where your best secure investment may be 2%, that looks pretty darn good. So the amount of capital that's flowed into this U.S. oil and gas business has just been absolutely phenomenal. And so all of that money that came in created this gigantic bubble. And you're right that oil prices from 2010 to 2014 never went below $90 a barrel. That's 4 years. And previous booms maybe lasted a year and a half or 2 years or whatever. So what happens is when oil prices are so high for so long, it destroys demand. Yeah. And when demand is destroyed on top of oversupply, well, there's no other option than a huge deflationary cycle, and that's what we're hopefully working our way out of right now.
Yeah. Well, yeah. The best cure for low prices is low prices, and as the cliche goes. So, how long is it going to stay here? Unfair question. I don't know that anyone can predict it, but you have to go through that capital cycle too, right? Well,
you have to work through all the oil that's been put in storage. Okay, so a big part of any commodity has to do with your inventory. Okay, just like in a store, you buy a lot of inventory, and if demand for your product goes down, then you got to sell off the inventory before you're ready to buy more stuff to put on the shelves, and that's what we're dealing with here. And so we look at the amount of oil that's in storage right now in the U.S., both in underground storage and tank farms and whatnot. It's at an all-time record high. And so we've got so it's not just a matter of getting producers to slow down or the amount that they're outputting, but we also have to work through that inventory. We got to get all the stuff out of the back room until so that prices can begin to increase. And at the rate we're going right now with this OPEC and a couple of non-OPEC countries have cut production, that puts us on a much better path towards getting there, but it's still going to be, at least 6 months or a year before we and the rest of the world work through all of that inventory, and that's assuming that everything works just like it's supposed to. So yeah, these things they don't happen quickly. They just don't happen quickly. And people who think that, oh, well, now that, OPEC has done all this great stuff, then, happy days are here again and good times are right around the corner. I just don't think that's the way that an integrated world economy works.
Yeah. Yeah.
So maybe, I don't think it was an unfair question. So there's my answer. But the reality is that, getting back to the financial collapse in 2008, is we've got a world economy that is incredibly fragile. It's so overweighted with debt that you've really got to, we're talking right now just about oil supply and demand, but you got to start asking, well, what is the capacity of this weakened global economy to get all fired up again? We've kind of used the no interest rate card, and we've had a couple of whopping 0.25% increases here in the last several years, which is certainly a step in I guess a good or the right direction. But we're out of bullets on that deal, and so the concern that some of us have, and I certainly have, is all right. Oil's gone from $30 to $50 a barrel. It takes a long time before you start to see the effect of higher oil prices on demand. Is $50 what the global market can tolerate, or could it take $60? I don't know the answer to that, Gary, but I think it's a valid question. And so, people who think that, oh, well, it's going to go back to normal, whatever normal was, prices will get to $70 or $80. Well, if they do, great. But I have serious doubt whether the global economy can manage that level of cost at this point.
Yeah, and then the cost of producing oil. There's so many countries that are going bust producing now, right? In the Middle East.
Yep. Venezuela is the biggest concern to me, to be honest with you. You're right on our back doorstep here.
Yeah.
I mean, that country is on the verge of total collapse. And United States imports an awful lot of our oil from Venezuela. I can't remember if it's third or fourth or something like that, but it's right up there on our list of importers. Canada's number one, and I think Saudi Arabia is number two, and I can't remember if it's Nigeria or Venezuela is number three, and then Mexico after that. So. So Venezuela is a country that is almost solely dependent on oil production for its revenue, and they're having some pretty tough times in Venezuela.
Yeah, that's for sure. Yeah, I mean, you hear the stories. It's just you can't even believe it that it was almost a first world country, and now it's having trouble just being a third world country. So you got to wonder. That's for sure.
Right.
You got to wonder. So one other thing I just want to talk with you about here, alternative energy. So you're an energy expert here. Alternative fuel, alternative energy, wind, solar, electric cars. We're a long ways from any of this really becoming meaningful to the global energy picture, aren't we?
Well, for better or worse, and I'll say unfortunately, yes, we are. It's again, you've got to somehow cut through all of the promotion and the marketing and the propaganda and that you hear, whether it's from the oil business or from the renewable energy business. I mean, they're a business, just like any other, and they've got their promotional narrative, and if you listen to that narrative, what you hear is that the price of solar panels and wind turbines and all of that is going down tremendously, and therefore they're we should be able to see our way to an electric future in not very much time. Well, in some ways, I suppose that would be desirable for all of us to get away from burning fossil fuel and all of the concerns that many people have about that, from emissions and the climate and the environment and all that sort of stuff. But the truth, unfortunately, is that the total, of our total energy budget consumption as a world or as a country, it's less than 3% today is actually provided by renewable energy, meaning solar and wind. And now when people talk about renewable, they like to throw in things like hydroelectric, because that's a big number, it's like 15%, but that's not new and that's not growing. So, cut it down to the part that everybody's excited about, which is wind and solar, and it's 3%. And so what does it take to get from 3% to, make up a number, 20%, 50%, whatever? And the answer is, it takes a long time. You don't make those big kind of changes overnight, no matter how much you want to, no matter how much, it's even legally mandated. You're just not going to make those changes. I mean, think about when the United States decided to go to digital television from analog television. That was kind of a no-brainer. 80% of people in the country had already shifted to digital cable, if you will, on their own. And so there were only 20% of the population that had to make that change. And they said, okay, we're going to do that in a year from now or 2 years from now. I can't remember. And for all you guys that haven't made the change, all you got to do is drive someplace and pick up a box for free. Yeah. And then you'll be digital. And we had to delay that transition for years because we couldn't get the 20% of people to go someplace and get something for free. Yeah. That's very true. So when people tell me that we're going to go from 3% electric to, let's just say, even 20%, and it's going to happen like really quickly, I think, oh, okay, and that's not free. That's not free, and it isn't as easy as going and exchanging a box. So the problem with renewable is it's not about the headline cost per kilowatt hour. The real problem is that renewables are a bad match with the demand-driven system of power that our culture has gotten used to. I mean, when I want to use power, whether it's a car or a microwave oven or an air conditioner, I want it now. I don't want a brownout. I don't want a blackout. And the problem with wind and solar is that it's intermittent. Okay, and so when you go to wind or solar, you've got to back it up with a natural gas system that allows you to continue generating electricity when the sun doesn't shine and the wind doesn't blow. And so you got that problem right there, and that's that's not without some potential solutions, but it's again it's going to take some time. The other issue, which is huge, is that something like 75 or 80% of the energy we use in the United States is non-electric, and a tremendous amount of that is gasoline, jet fuel, diesel. Almost all of our transport is liquid fuels. Okay, so to displace all of the hundreds of millions of internal combustion engine vehicles in the United States with electric, again, I'm not saying you can't do it, and I'm not saying you shouldn't do it. I'm saying it's going to take a lot of time. It's going to take a lot of time to retire all that fully functional equipment and get to something different. And then there's the okay. So let's say you're successful at getting a lot of people to buy electric cars or whatever. Well, then you got the electricity grid, which is barely hanging on at current electric power demands. And what are you going to do if demand for charging your electric cars goes through the ceiling? Well, there's another multi-trillion-dollar investment in tearing up a lot of cities and streets and whatever to put in all that infrastructure. And again, I'm not trying to be pessimistic or negative. I'm just trying to inject a little bit of reality into what people's, I think, optimistic but unrealistic expectations are. It takes time.
Oh, yeah. It takes time, a lot of investment, a lot of new power plants. How many nuclear power plants is it going to take to convert the entire transportation fleet, not including trucks, just say cars, electric cars, over 120 million or whatever the number is? It's over 100 million vehicles on the road. How many is it going to take to do that? It's a staggering number. It's really staggering.
We haven't built a new nuclear power plant in the United States for decades because nobody wants them.
Yeah,
okay, so you don't want to do nuclear. So what are you going to do? Yeah. Where's the electricity going to come? I mean, you don't manufacture things like solar panels and wind turbines with solar power and wind power. You do use manufacturing uses electricity. Where's the electricity come from? Most of it comes from coal and natural gas. Well, coal and natural gas are fossil fuels that we say we want to get away from. But, so everywhere we turn, I mean, our world economy is so reliant on oil, natural gas, and coal that it's no matter how much we want to change, no matter how much we need to change, it isn't going to happen fast, and it's sure not going to happen cheaply.
No.
So if we are successful at making a significant shift to renewables, that is going to, I think, exaggerate the downward trajectory in economic output of our industrialized societies. I mean, here's the thing that most people just don't have any idea of: the amount of energy that's contained in a barrel of oil. Okay, it's phenomenal. If you just work it out into calories, there's about something like 4 or 5 years worth of an ordinary person's manual labor contained in a barrel of oil. So that's what we call energy density. We got a ton of energy packed into a pretty darn small package. And that is the absolute beauty and miracle of oil. We have never found a source of energy that is not only so dense, but so easy to move around. You pour it into your car and you can drive 400 miles. You pour it into a jet airplane and you can fly halfway around the world. We've just never found anything like it. And I'm sure not going to say we'll never find something better. But when you start talking about renewable energy, I mean, you're talking about a source of energy that is hugely less dense. I mean, diffuse. And so to keep society running at the very high level of energy consumption that we've gotten used to with fossil fuels from electricity, it's very unclear to me how you even do that. Yep. And so if you believe, and I think it's absolutely undisputable, there is a correlation between energy consumption, oil consumption, and GDP. You look at a country with an advanced economy and high GDP, like the United States or Western Europe, Canada, we use a lot of oil.
Yeah.
You look at undeveloped or less developed countries, poor countries, they use per capita a whole lot less oil. So we like to think about these things in a vacuum. But everything interconnects, and the world is complicated, and I just wonder if people who somehow see a clear path to a renewable energy future understand all of these these additional details that go along with it. Again, I'm not trying to be negative. I'm all in favor of energy transitions and more. And the renewable energy there's no doubt it's going to be an increasingly large part of our future and an important part. I'm just saying let's just get realistic about the timeline.
Yeah, I totally agree with you. But again, it's one of those things people really don't like to have a factual debate on, and it makes it difficult to really set policy on, because our energy policy at this point, Art, was based on very implausible goals set for these alternatives and renewables, and hopefully now maybe we'll get a little more realistic. Anyway, Art, really appreciate you coming on the show. It's been great having you. Just tell us where we find you on the internet, the website.
I'm at artberman.com. Just my name, ARTBERMAN.com. And it's one of those rare websites where there's no place on it you can pay for anything. It's all free.
Well,
so check it out. And there's no advertising. There's no nothing, just information. So come see what I've got.
We like those sites. And we'll have a link to your site in the show notes to this interview on our site, financialsurvivalnetwork.com. Sign up for a newsletter. Any questions, comments on this interview, and I'm sure there's going to be a lot, just send us an email, kl@kerrylutz.com, kl@kerrylutz.com. Twitter feed is @kerrylutz, and the Facebook page is Financial Survival Network. We'll definitely have you on again soon, Art. Thanks so much for coming.
Pleasure. Thanks, Kerry.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.